Citigroup, ringing the opening bell this morning. Our opening bell coverage is sponsored by Flex Shares here as we have this negative weight. And it's interesting, guys, and Inez, as we watch, a pretty broad-based decline, although it's interesting to see energy in the red once again as we see sort of a rotation out of one of the year's best performers.
Yeah, I think what you're seeing in these markets, we talked a little bit with Andy and Brian, it's just an acknowledgement by the Fed that they're willing to let unemployment tick up and potentially just teeter on the brink of a recession to go out there and fight inflation. Now, of course, they're not trying to cause a recession, but still the optics of this is clearly something the market does not like.
I think there were some really interesting tidbits on the GDP growth predictions as well that came out yesterday. In their summary of economic projections, the participants of the Federal Open Markets Committee, they marked down their projections for economic activity. Median for real GDP growth now, they're looking at that running below 2% through 2024. And so I think the market's also digesting a little bit of not just what the Fed is saying, but internationally, the global picture around a GDP slowdown in growth right now, and even a contraction in some areas of the world.
Hey, Inez, can we get you back in here? Because I'm curious in particular what we're seeing from the financials. We talked about large cap tech. That has been an area that's been vulnerable. What's been interesting in the financials, as we talked about with David Ellison of Hennessy yesterday, is this sort of like, I don't know, that there are positives and negatives from a higher rate environment, right? But at the same time that you have a flattening yield curve. And it's a tougher environment for the banks than you would expect. And certainly an economic slowdown is not necessarily good news for the banks either.
Yeah, that's right. And that's really become now the sort of thesis or the narrative is all else being equal, that economic slowdown. So if you are raising rates, this is what everyone is concerned about. And it's not good for any of these industries. Take a look right now at where we're at with the sectors. As far as financials are concerned, XLF down 2%. And if we just take a look at the bank stocks, you're seeing red across the board, except for Nomura Holdings, of more than 1%. But everything else is seeing declines, guys. I do also want to note one other thing that I've been watching also today, and that is oil, because we know that in order to get inflation down, you need to get oil prices lower. And we are seeing WTI right now down 1%, Brent crude down 0.8%, as these central banks are raising rates. Of course, again, that concern of a slowdown. The way you're going to get, I've spoken to a lot of experts about this, the way you're going to get gasoline prices down, the way you're going to get oil prices down, it's not necessarily on the supply side right now. It would be on that demand side.
Well, the other way, Inez, of course, is if the government sent us all electric cars. Inez Ferre, great stuff as always. Appreciate it.